Hello. Shall we start? Can you hear me?
Yes, madam.
Yes, okay, we can start. So after two weeks after your mid examination, so now we have to start from investment income. Up to now we studied for in employment income and the business income. So that now we are in the journey of calculating assessable income from a taxpayer. So first source we calculated was employment source, then the business source. Now we are doing for investment income source. So what is the meaning of an investment? What is the meaning of an investment? So we know about the business income. For the business income, there are profit earning intention. There were some criteria for business income as well. For the investment also we have specific requirements. So in section 195, so that is the interpretation section in the act, it says what is investment. So investment means the owning of one or more assets. That means for the business, if it is in the business, we do not hold that asset for a long time, because the business is, the intention is not holding an asset but selling of that asset. But investment means we are holding that asset for some time period, so that after holding that asset for a period we can earn some income. We call it investment income. So for that purpose there may be present investment or prospective investment, but we should exclude business or employment income. That means if we are receiving some income, if we can categorize that income under employment or under business, we have to do so. If we cannot categorize that income under employment, then under business, then we have to consider whether we can categorize that income under investment. It is the third source. Then it should be a game of chance, including lottery, betting or gambling. That means investment can be one of two or both. So one is holding an asset and we have to earn some amount by using that asset, and the next one is game of chance, including lottery, betting or gambling. That means if we are receiving some winnings from lottery, betting or gambling, that is also a part of the investment. So these are the several types of investment income. One is dividends. So if we are keeping share ownership, the return is dividend. Therefore we consider it as a dividend income and we have to categorize it under investment source. Likewise, if it is an interest income, if it is a discount, charge, annuity or a natural resource payment or a rent or premiums and royalties, should be categorized under investment. So we will receive this kind of income by holding some assets. Then the next one is gains from the realization of an investment asset. So we have a specific definition for the investment asset as well. For the words I have already underlined, you can see the definition in the definition section, that means under section 195. So for the dividend you can see the definition. For the interest, for the natural resource payments and for the rent. That means for the discounts, charges, annuities, we don't have specific definition under Inland Revenue Act. So the next one is gains from the realization of investment assets. So you can see there's a specific term, that is investment asset. So if it is an investment asset and after realizing that investment asset, if there is a gain, that gain should be categorized under investment income. Likewise, if we have a business asset and after realization of that business asset or a depreciable asset, and if that is a gain, that gain should be categorized under business income, not the investment income. So you should know the difference between an investment asset and the depreciable asset and the business asset. So if it is an investment asset, after realization of that investment asset, and if it is a gain, that only that gain should be categorized under investment income. The next one is a gift. If we are receiving a gift in respect of an investment, it should be categorized under investment income. If we received a gift under employment income, it should be categorized under employment source. If it is a gift received in respect of the business, that gift should be categorized under business income. So you should have a knowledge, you should have the ability to understand, and you should have that's knowledge to categorize that income whether under employment, business or investment. Then the next one is winning from lotteries, betting and gambling. In the definition itself, it has mentioned under investment category. Then other amounts. So these are the income we have to categorize under investment income. As well, there are some specific items that we have to exclude when we are considering the investment income. So first of all, we have to identify this kind of income, and we have to categorize them under investment category. If there are income that we can categorize under these items, so we have to exclude that kind of income. So those are the exempt amounts and final withholding payments received in respect of the investment like investment return. So we have to exclude that kind of income. That means if we are receiving some income, some interest income, if it is exempt, then under this part we have to exclude it. If we are receiving some income like this, and if it is a final withholding payment, we have to exclude it. So first of all, we have to include all these income. Then we have to consider whether those are exempt amounts or final withholding payments. So if it is exempt under Schedule 3, or if it is a final withholding payment under Section 88, then we can exclude that income from investment source. The next important thing is, when we are identifying these investment returns, we have to consider whether we can categorize that each of income under business source or employment source. The most dominant one is the employment. Therefore, first of all, we have to consider whether it should be categorized under employment source. If not, then we have to consider whether it should be categorized under business. Then we have to categorize that kind of income under that employment or business category, not under investment income, because most dominant income source is employment, then business, last one is the investment. If we cannot categorize any income, if we cannot categorize income under any of these three sources, then only we have to consider to be categorized that income under other income source. So what is the method of accounting? What is the meaning of method of accounting? Method of accounting means when we have to identify that income under these categories. That means, I think you can remember, if we are receiving an employment income, we have to consider it on a cash basis. That means once we are receiving that income, at the time of receiving that income, we have to consider it for the taxation. Likewise, investment income also a cash basis for an individual. So, any individual shall account for income tax purposes on a cash basis in accounting the individual's income from investment. That means there may be some bank deposits. We deposited that amount in 2024 for 3 years period. Suppose it is for 3 years period from 2023. If we have deposited that amount in 2023 and if it is matured in 2026 January, February or March, then we have to consider that interest income for the year of assessment 25-26, even though we have invested that amount in 2023. That is the way of accounting any income under cash basis. So that is for an individual. If we are considering an entity, such account for income tax purposes either on cash basis or accrual basis, whichever properly computes the entity's income from investment. But in the normal course, we consider it under cash basis. Normally, we consider investment income under cash basis. So, for the dividends, we have a specific definition under section 195. So, dividends are not only the dividends declared by the companies. There may be in other methods, other way, the directors can, the company management can distribute their dividends not as dividends. By another way they can do it. So all that kind of distributions can be considered as a dividend. So for that purpose we have a specific definition under section 195. So you have to refer these specific definitions in section 195. So under section 195 we have a specific definition for dividends. It says means. So we have that specific term means, not includes. It means, dividend means a payment derived by a member from a company. That means from a company. Who are the members? Shareholders of that company. If that shareholder derived payment from the company, we can consider it as a dividend, whether received as a division of profit in the course of a liquidation or reconstruction, in a reduction of capital or share buyback or otherwise. That means it can be in several ways, but the nature is the amount we are receiving from a company since we are a member of that company. So we call it a dividend. It includes a capitalization of profits like bonus issue, increase in the amount paid up on shares or otherwise, whether an amount is distributed or not. So whether it is distributed or not, we can consider it as a dividend. But we have to exclude these things matched by a payment made by the member to the company. If a member paid some part of the to the company, we have to exclude that. We have to exclude that amount, because to receive something from the company, suppose we also have to pay some amount to the company. So we have to exclude that part to consider the amount of the dividend. And the next one is debited to a capital, share premium or a similar account, or otherwise constitutes a final withholding payment or is included in calculating the income of the member. So if we consider it as a final withholding payments, then also we have to exclude that payment. So now I think you have an idea about the dividend. it should not be only in cash or likewise, but in different way we can receive that kind of dividends for the purpose of taxation. Therefore, it is not necessary to receive as a dividend, but dividend, any amount that receiving from a company, since that person is a member, we can consider it as a dividend. Then the interest income. So for that interest income also we have a specific definition under section 195. It gives a payment including a discount or premium, because for some times we do not receive interest, but we are receiving some amount after discounting. And the next one, made under a debt obligation. So we are receiving interest due to a debt obligation, that is not a repayment of capital. So it is not a repayment of the capital, but if we are receiving some amount from the from some person for the debt obligation or for the deposits, so we can consider it as an interest. A swap or other payment functionally equivalent to interest. A commitment, guarantee or service fee paid in respect of a debt obligation or swap agreement and a distribution by a building society. So we can receive any amount in respect of this kind of things. So the next one is natural resource payment. So prior to that, we should have an understanding about natural resource. So what is the meaning of natural resource? Natural resource means minerals, petroleum, water or any other non-living or living resources that may be taken from land or sea. That means there are a lot of things we are receiving from land or sea. We are not collecting it after making some effort, but we are receiving something, natural thing. We have not manufactured water, we have not manufactured any other thing. It is naturally we have that resource. So for that natural resources, if we are receiving some amount, we call it natural resource payment. So payment means payment including a premium or like amount for the right to take natural resources from land or the sea, or calculated in whole or part by reference to the quantify or value of natural resources taken from land or sea. There may be a huge rock, there may be sand, there may be some other thing. We are receiving that from land or sea. If we are receiving some amount for that natural resources, that amount also should be considered under investment income. Then annuities, no, there is no definition in that for annuities, but we have a specific definition since our previous acts. But if it is an annuity, we will receive that income annually. So if we are receiving some fixed amount for some specific period, we call it annuity. Then a rent. For the rent also we have a specific definition under section 195. It means a payment including a payment of a premium or like amount for the use of or right to use. Two wordings are there, use of or right to use. Property of any kind, that means for a property, there is a property. For the use of or right to use of that property, we are receiving some amount. We call it rent. For an example, we have a property, we have a building, we have rented it out, we have given the right to use of that property to another person. So for that purpose we are receiving some amount, we call it rent. So that is the rent income. It can be either a property or a vehicle or any other thing. So there should be a tangible thing. If that is a tangible, if it is a tangible thing, and if we have given use or right to use of that tangible thing, we receive rent. Then it includes a payment for the rendering of or the undertaking to render assistance ancillary to a use of a right referred to the above. That means not only the rent income, if we have given some other ancillary services with regard to that specific property, that income also a part of the rent. Not only the rent income we are receiving, any other services associated with that property, and that income also should be categorized under rent income. But it should exclude natural resource payment or a royalty, because for the natural resource payment and for the royalty we have another specific definitions. So when we are identifying some income under rent, it should not be categorized under natural resource payment or royalty, because that is two different income sources, income types. In the case of an individual with rental income from an investment asset, an amount equal to 25% of the total rent income for that year of assessment as a relief can be deducted. So this is a specific relief. I will explain this under taxable income part, because when we are calculating the taxable income, I will explain it. So this is just a reminder that we have this kind of a relief. I will explain when we are referring taxable income. Then I am talking about royalty income. For the royalty income also we have a specific definition. You can see it here. You can see that definition here. Royalty means a payment including a payment of a premium or like amount derived as consideration for the use of or right to use a copyright of literary, artistic, scientific work, including cinematograph, films, software, audio or video recordings, whether the work is in electronic format or otherwise. So for the rent also we had similar type of definition. Here you can see the definition for rent. It says the use or right to use of property. So that is why I said for the rent income there should be a tangible thing. But for the royalty income we cannot see any tangible thing. All are intangible assets. So that means for the intangible assets and for the use of or right to use of that intangible asset, we are receiving royalty, not the rent. But for the property, we are receiving a rent income. So there may be for several types of assets. So this is for copyright, scientific work, software, video, audio recordings, anything can be, and the use of or right to use of that kind of things, we are receiving royalty income. The use of or right to use a patent, trademark, design or model, plan or secret formula or process. The use of or right to use by industrial, commercial or scientific equipment. The use of or right to use information concerning industrial, commercial or scientific experience. The rendering of or the undertaking to render assistance ancillary to a matter referred to in paragraph A, B, C, D. A total or partial forbearance with respect to a matter referred to in A, B, C, D, or E. So I think now you can understand the difference between rent income and the royalty income. For both, there should be the use or right to use and there should be an asset. It can be either in tangible asset or intangible asset. And for that kind of assets, if we are receiving some income, we can categorize that income under investment source. Now we are moving to the gift received by the person in respect of the investment. That means if we are receiving some gift, then we have to consider why we are receiving this gift. If we are receiving that gift in respect of an investment, the market value of that gift should be categorized under investment income. Then winning from lotteries and betting or gambling, that is also a part of the investment income. However, no deduction is allowed for the deduction. No deductions are allowed for the calculation of the amount of winnings from lotteries or betting and gambling. That means for betting or gambling, we also have to spend some money. So we are not going to allow that kind of deduction for the consideration of investment income for tax purposes. That means no deductions are allowed, but total winning amount should be considered. Then other receipts. Discount, the gains received from the casual discounting of bills of exchange. So when we are receiving some amounts, we can consider it as a discount, not the investment, not the interest. So that kind of discounts also a part of the investment income. Then a charge. Charge is a sum received by a person under deed or an order of court which is secured on the income or property of payer. So actually for these wordings we don't have a specific definition. So but we don't have a specific definition, but in normal general definitions can be considered for these wordings, since we don't have a specific definition in that. For the premiums are payments received as a consideration for obtaining the right to use a property rather than for the actual use of the property. So this is the definition we have. I collected these definitions from our previous acts. So these are the definitions available in the previous acts. So in the new act we don't have a specific definition. So now we can move to the exempt amounts under third schedule. There are a lot of exemptions under third schedule. So you can see these definitions. First of all, I will explain these definitions in these sections, and then we can move to the act, because there are some sections we have already closed under several amendments. So I have removed that kind of exemption. So these exemptions are available now. So first exam is interest accruing to or derived by a charitable institution. Prior to that, let's move to the Consolidated Act. So this is the Consolidated Act. In the Consolidated Act, you can see the third schedule. So third schedule is for exempt amounts. In the first part, you can see some institutions. So these institutions are exempt from income tax. So you can see the wordings used in this schedule. It says the following shall be exempt amounts. A. Amounts derived by the government of Sri Lanka or a local authority, including any government department. That means amounts derived by this organization. So any amount derived by these kind of organizations are exempt from income tax. So it can be either business income, it can be either investment income. So every income, business or investment income, are exempt if that organization is a government of Sri Lanka or a local authority, including government department. Then the Central Bank of Sri Lanka, including the Monetary Board. So activities, business activities of the Central Bank and investment activities of the Central Bank all are exempt from income tax if it is a Central Bank or a Monetary Board. The next one is the university, which is established or deemed to be established under the Universities Act. It includes Buddhist and Pali University. That means business income and investment income of this kind of universities are exempt from income tax. Then government assisted private schools other than the incorporated and companies act. So you can see government schools are exempt from income tax. So we have a specific inclusion under new amendment Act number 11 of 2026 also. Then cooperative societies are exempt from income tax, either it is from business source or a investment source. Then government of a foreign country or foreign territory to the extent specified under a diplomatic immunities law or a similar law, that is also exempt. Then the international organizations, their business and investment income also exempt. So if we are considering this kind of organizations, income from business and investment are exempt. Then there are some exemptions from B. A is for specific institutions. From B, that is for amounts. So some amounts are related to employment income, some amounts are related to business income, some amounts are related to investment income. So we have in this schedule 3, it is not specifically categorized to these specific sources. We have to read it and we should identify whether it should be an employment part, amount, business amount or a investment amount. When we are reading that exemption, we can identify under which category that is exempt. So if we are going one by one, capital sums from person as compensation or a gratuity in relation to personal injuries and death of another person, that is exemption for employment income, because we are receiving that kind of compensations since we are an employee. Then the pension also we are receiving for employment, so that is also an exemption for employment. Then amount paid to an employee, then part D also for the employment income. Then part E, that is also for the employment income, because diplomatic immunities law is applicable mainly to that kind of employees. Then again made by a resident individual from the realization of an investment asset. So you can see this is specifically applicable for investment asset. If we are receiving some amount return from the investment asset, it should be an investment income. That means F is applicable for a investment income. So it is for a capital gain. So when we are discussing this capital gain, I will explain it again. So this says, if we are receiving after realization of an investment asset the gain not exceeding 50,000, that is exempt, or if for a year if it does not exceed 600,000 capital gain, it is also exempt. Then we can move to G, a gain made by a resident individual on the realization of individual's principal place of residence. So that is also applicable for investment source. It is also applicable for investment source. Please keep at least in your mind this kind of things are available in that. If you have a doubt, you can refer Schedule 3 to be identified whether that is exempt amount or not. So G is for the capital gain part. Capital gain is also a part of the investment asset. Then GG, a gain made by an entity of which more than 50% of direct or indirect membership interest is owned by the government. So we are discussing about the membership interest. For the membership interest, we are receiving some amounts. So if it is direct or indirect membership is owned by the government of Sri Lanka as a gain from the realization of a capital asset or a liability of the business, or realization of an investment asset. Now we are discussing about the investment asset. Therefore, this GG is applicable both to business income and investment income. Then H, gain made on realization of an asset consisting of shares quoted in any official list published by the stock exchange licensed by the Securities and Exchange Commission of Sri Lanka. That means if it is a listed company, the gain on the realization of that kind of shares is tax exempt. Then gain made by a person on or after April 1st, 2021 but prior to October 1st, 2022. That means this HH is not applicable for your tax computation. That means now we are doing our calculation for the year of assessment 2025-2026 year period. So this exemption is already closed. So this is not applicable after October 1st, 2022. Then we have another one, the interest accruing to or derived by. That means now we are discussing about an interest income. So interest income is applicable for investment source, mainly to investment source. Therefore, these exemptions are available for investment income. So I have included these investment exemptions in that slides, but it is better if you can refer Schedule 3 for more understanding about the exemptions available for investment source. So charitable, if the interest accruing to or derived by a charitable institution, that means if that institution is a charitable institution where it is proved to the satisfaction of the Commissioner General that such interest is applied solely for the purpose of providing care to children, the elderly or the disabled in a home maintained by such charitable institution. That means if we are receiving an interest to a charitable institution and that charitable institution is use that interest solely for the purpose of providing care to children. That means there are a lot of charitable institutions. So to all charitable institutions, this exemption is not available. This exemption is available only to the charitable institutions that are providing care to children, elderly or disabled in a home maintained by such charitable institution. Then only that interest is tax exempt. Then the interest accruing to or derived by any other outside Sri Lanka on any loan granted to any person in Sri Lanka or to the government of Sri Lanka by such person. So that is also exempt. So if a person received interest on any loan granted to any person in Sri Lanka, that means that person should be outside Sri Lanka. If that person granted a loan to a person in Sri Lanka or to the government of Sri Lanka, and if that government pays interest to that person outside Sri Lanka, that interest is tax exempt. Any person on monies lying to his credit in foreign currency, in any foreign currency account opened by him or on his behalf in any commercial bank or in any specialized bank with the approval of the Central Bank of Sri Lanka on or after January 1st, 2022. That means after January 2022, if we are receiving any money in foreign currency as an interest, and if that money is in the foreign currency account, then that foreign currency interest is tax exempt. So all these conditions should be fulfilled. It should be an interest, it should be received in foreign currency, it should be in foreign currency account in Sri Lanka. The next one is any person from a term deposit account titled as Special Deposit Account, SDA, Special Deposit Account, opened and maintained with an authorized dealer in Sri Lanka as prescribed by regulations made by the ministry. Oh, there are a lot of things. In any designated foreign currency or in Sri Lankan rupees. So here it should not be in only foreign currency. It can be either in foreign currency or in Sri Lankan rupee, but it is open as special deposit account after April 1st, 2020, or any welfare society on or after April 1st, 2028. So if we have received interest from this kind of account, it is also exempt. Then any welfare society on or after April 1st, 2021. That means if a welfare society received any interest amount after this date, that interest is tax exempt. So we have given a specific definition for welfare society. So if we are calculating a welfare society's tax liability, if we are receiving interest income, we can consider it as tax exempt. Then any multinational company on any deposit opened and maintained in foreign currency in any domestic bank, if such deposit is maintained to cover its import expenditure, then it is exempt after April 1st, 2021. So we have given a specific definition for multinational company. Then any price received for research undertaken. So since it is a research, it can be for business income. Then we have other any sum received by any person from the President Fund established by the President's Fund account. If any person received any amount from President's Fund established by the President's Fund account or the National Defence Fund established by the National Defence Fund account, that is also exempt. So in the last last around 2018-2019 period, lot of doctors requested this exemption, requesting that they are receiving amounts from the President's Fund for doing some operations for kidney disease, heart disease, like that, because from some donations are provided through the President Fund. So that donation is provided from the President Fund, not to the doctor but to the patient. So some doctors requested this exemption from the amount they are receiving from the President Fund, but it is to that patient. Therefore, under that doctor it is not exempt, but for the a person who received that amount sum from the President Fund is exempt. Any public corporation out of the funds voted by Parliament from the consolidated fund or out of any loan arranged through the government. So if that amount is received from the consolidated fund, that is also exempt. Likewise, there are a lot of exemptions, mainly when we are doing these calculations, tax calculations for individuals and companies. These are the exemptions available for interest income and other sources of income. So in addition to that, we can see some exemptions: interest discount or realization of any gain on any sovereign bond denominated in local or foreign currency. So any income earned by any non-resident person. So this exemption is for any non-resident person. So the next one is for any person by way of interest or discount. That means if any person received interest or discount on any sovereign bond denominated in foreign currency or Sri Lankan development bonds, that is tax exempt. There are a lot of tax exemptions under investment income. Again, from the realization of Sri Lanka international sovereign bonds issued on behalf of the government of Sri Lanka and received or derived by a commercial bank or authorized dealer who made an aggregate investment not less than $100 million in such bonds. That is also that gain also. That means we have to realize that sovereign bond. When we are realizing, if it is a gain, that gain is tax exempt. Then this is for the interest or discount. This is specifically granted to some of the community-based banks, bank deposit holders. That is also exempt. Any amount derived by senior citizen from an annuity for life for a period of not less than 10 years. So if it is a premium, that is also, it is an annuity, and if that annuity is for more than 10 years, that is also exempt if that person is a senior citizen. Then if it is a winning from lottery or betting or gambling, winning from a lottery, if that amount not exceeds 500,000, then it is not liable. That is also exempt. So this exemption is prior to January 1st, 2020, so that therefore it is not applicable for your computation. So after that you have another one, only after January 1st, 2020, but prior to October 1st, 2022, it is also not a part of your computation. So this is available for the calculation of year of assessment 25-26. That means only after October 1st, 2022, a dividend paid by a resident company. If we are receiving a dividend from a resident company, that is exempt. Dividend paid by a resident company. So we have specific conditions which is engaged in one or more of the following businesses. So if that business in entrepot trade, offshore businesses, providing front-end services, headquarters operations, logistics services. So if we are receiving dividend from this kind of businesses, that is tax exempt. Exemption under P, benefits received or derived by an employee. So this is for employment income. This exemption under P is relevant for the employment income. Then Q, it says the property and income from any property donated by royal law other grant before March 2nd, 1815. That means prior to the colony, 1815, in the British government, prior to the British government, to any place of public worship administered by a charitable institution insofar as such profits and income are applied to the purpose for which such grant was made. So if we are having this kind of things, that is also exempt. Then dividends from and gains on realization of shares in a non-resident company were derived by a person with respect to a substantial participation. So that is a specific condition. If a person holds 10% or more value in some shares and it is controlled either directly or indirectly of that 10% or more voting power is available, then we call it a substantial participation is available. If there is a substantial participation, the dividends from the gains on realization of shares in a non-resident company, that dividends and gains on realization of shares are exempt. So this is for the previous period prior to October, not relevant for your calculation. Then under S it says any amount derived by a person from the sale of any gem or which tax has been deducted under subsection 2 of section 84. So that is a withholding. If that gem is subjected to deduction of the withholding tax, then that income is tax exempt, mainly it is applicable for your computation. Then so this is for Sri Lankan Airlines specific definition. Amounts derived by a non-resident person from engaging in a project of a government of Sri Lanka. So it is, if it is a foreign granted thing, so that amounts are tax exempt. So this is for the agricultural businesses. So this is applicable for business income. So providing information technology and enabled services on or after January 1st but prior to April 1st 2023. That means this is also applicable to business income. Prior to this date, prior to 2023, IT services and enabled services were tax exempted, but now it is liable. So this one also, this is also tax exempt, liable. So item number 3 is for any services, that means it is applicable for business income. Services rendered in or outside Sri Lanka to any person to be utilized outside Sri Lanka where the payment for such services is received in foreign currency and remitted through a bank to Sri Lanka. So this, we had this exemption earlier, now it is tax exempt, not exempt, that now it is liable. Any foreign source income, so that is also now liable. Now liable means prior to April 1st 2025. So you are doing your calculations for the period from April 1st 2025 to March 31st 2026. Therefore, these exemptions are not available for your calculation. That means if any person received income from information technology, from any services rendered outside Sri Lanka, from foreign services, those are tax liable. So this one also not exempt now. Okay, prior to April 22, that means we have closed these exemptions. So these laboratory services are exemption is still there. This exemption also not applicable now. Here you can see or no after 1st of 2021 but prior to April 1st 2023, that is also not available now. So if you have any doubt with regard to some income, whether that is exempt or liable, you can refer Consolidated Act. It is very easy for you to understand if you can refer the Consolidated Act. After that, we have not yet incorporated 2026 amendments. Therefore, Consolidated Act and the Amendment Act number 11 of 2026 should be referred. Most sections, most amendments in that Amendment Act number 11 of 2026 is not applicable for 26-27 year of assessment. Therefore, don't worry. Some are applicable, some are not applicable. So all these are not applicable for your computation. So this exemption is for Port City economic part. Gains and profits received or derived by an authorized person carrying on a business of strategic importance. So this is for applicable for business income and the employment income of an employee employed in terms of section 35 of the Act. That means not only the business employment income, also this X is applicable for employment income also. Okay, so I have explained most of the exemptions available in the Consolidated Act. That means up to 25th amendment. Then under 26th amendment also we have some changes, some amendments are there. So here I have mentioned some of the important exemptions available for investment source. So here you can see charitable institutions I have already explained. Then the person outside Sri Lanka on any loan granted to any person in Sri Lanka, so this is also still applicable. Then foreign currency account, if we have a foreign currency account and if we have deposits in that foreign currency account, that interest is tax exempt. Then the welfare society, if they are receiving income, that is also tax exempt. Then any prize, that means President's Fund, if we are receiving some prize, it is a gift. So if we have received any gift in respect of the investment, that is tax exempt. Non-resident person income, that is sovereign bond issue, so that is also the interest on sovereign bond, that is also tax exempt. This is also for sovereign bond. This is the third one also for sovereign bond. So those interests are tax exempt. Then interest or discount derived from the Samurdhi community based banks, that is also tax exempt. Then the annuity, that is also tax exempt, as I have already explained. And any lotteries, betting or gambling, if not exceeds 500,000. That means if our winning is less than 500,000, then it is exempt from tax under investment source. Then the dividends, I have already explained this part. Want to portray of offshore like that. So if any person is engaging in this kind of businesses, the dividend declared by that companies are exempt from tax. Here the substantial participation part. So if any person is a member under substantial participation, so if that person receives dividends, that is also tax exempt. If a gem or jewelry already if all withholding taxes are already deducted, then that is also tax exempt. So those are the exemptions available under investment income. So if you have questions, you can ask now. If not, we can move to the next set of slides. So I am going to do some explanations and some main provisions. I am going to explain some main provisions with regard to the investment income and the capital gain. So I think you can remember, under investment income we have to categorize capital gain. So in my first sets of slides, I have mentioned, I have included what total things that we have to include under investment income, not only the business. Here, gains from the realization of investment asset means capital gain. So not only the dividend, interest and all other things, gains from the realization of investment asset means capital gain. So all these things I have already explained. So now we can move to the gains from the realization of investment assets. So here I have lot of things to explain and it is very important. Therefore, now we can move to the gains from the realization of investment asset. That is a part of the investment asset, investment income. So if you don't have any question, we can move to the next sets of slides. So if you have any question regarding the slides, regarding the provisions I have already explained, you can ask now. Do you need a break? It is 8:15. Do you need a break or can we continue? සමහර විට ඔෆිස් ගිහිලා ආපු ගමම වෙන්නත් පුළුවන් නේද? break එකක් ඕනනම් කියන්න. If you need a break, I can give you 15 minutes break. If not, I can continue. Can we have our mid-exam marks? So your mid-exam marks will be given with the final exam marks, I think. Prior to that, they are not going to issue mid-exam marks. In the previous years, we have not issued mid-exam marks prior to your final results. So I think they are not doing it. That mid-exam marks will not be issued prior to the final examination. I'm sorry, I have not yet shared this document set, so I will share it today after we finish the session. I will share these slides with you. So this is gains and losses from realization of assets or liabilities. So this is mainly applicable for the realization of assets and liabilities under investment. Not only under investment but under business also this is applicable. But here we are discussing mainly some part, that is capital gain part. So we call it gains from the realization of an investment asset. But this set is not only for the investment asset but for all gains and losses from realization of assets and liabilities. So for that purpose you should have this knowledge. You should know what are the types of assets. In my first session also I explained the types of assets, because there are a lot of assets in an organization. Trading stocks, investment assets, capital assets, business assets, depreciable assets, like that. There are a lot of assets. There are a lot of assets in an organization. So you should know mainly what is the difference between these assets. So asset includes a tangible or intangible asset. So this is the definition given for asset under section 195. Includes tangible or intangible asset, currency, goodwill, know-how, property, a right to income or future income, a benefit that lasts longer than 12 months and a part of an asset. Then from that asset we can identify some asset as capital asset. Prior to the explanation of investment asset, I like to explain about the capital assets. So what are the capital assets? Capital assets means each of the following assets: land or building, a membership interest in a company, partnership or a trust, a security or other financial asset, an option, right or other interest in an asset referred to in the foregoing paragraphs, but it excludes trading stock or a depreciable asset. So I have already explained what is trading stock and what is depreciable asset. For the depreciable assets we calculated capital allowances under section 16. So since we are removing depreciable assets and trading stocks, you can understand that under capital assets we cannot identify trading stocks and depreciable assets. So depreciable asset means an asset that it depreciates when we are using it. It depreciates when we are using it. So for the depreciation, for the consideration of an asset as a depreciable asset, that asset should be used for the purpose of business. Used for the business. Two criteria are there. Two criteria. One is there should be a depreciation when we are using it for the business. So if it is a capital asset, then you can understand that the capital asset shall not include depreciable assets. So these both conditions should be fulfilled. So if we are considering a land, the lands are not depreciating. Value of the land is not depreciating. Therefore, we can consider a land under capital asset. Then the building. If it is a building, buildings are depreciating. But not only the depreciation is the criteria, but we have another criteria that is that asset should be used for the purpose of the business. So there are some buildings we use for the business purpose. Some buildings we are not using for the business purpose. So if a building is used for the business purpose, we cannot include it under capital asset because there are two criteria to be considered whether it is a capital asset. Since land is not a depreciable asset, so we can consider it as a capital asset. But the buildings can be depreciate, but buildings can be used for business purpose and for investment purpose. If it is a business purpose building, then depreciation can be granted. Therefore, buildings that are using for the business purposes shall not include under capital asset. Then here we are considering buildings that are not using for the business purposes. Okay, I think you got the point. Then I will move to the investment asset. Then what are the investment asset? Investment asset means a capital asset. That means assets included here. Capital asset held as part of an investment. Capital asset held as part of an investment. So even though this land is not depreciating, if that land is using for the business purpose, we cannot categorize that land under investment because it should be a part of an investment. Therefore, to be considered a capital asset and investment asset, that should be a part of an investment, not the business. So there are lands. Some lands are using for the business purpose. Some lands are using for the investment purpose. So under investment asset, we can consider only the lands that are using for the investment purpose. There are some buildings are using for the business purpose, some are for the investment purpose. Therefore, buildings that are held as part of an investment will be categorized under investment asset. So now you can understand what are the capital assets and what are the business assets. So why do we categorize these assets into two categories? Capital assets held as part of an investment, capital assets held as part of a business, because applicable provisions for the investment assets and the capital assets held as part of the business are different. Applicable provisions, applicable rates, applicable method for the calculation of gain and losses also different. That is why we have to categorize these assets into the correct category. So investment asset means a capital asset held as part of an investment asset, but excludes the principal place of residence of an individual, provided it has been owned by the individual continuously for the 3 years. That means if an individual means not the person, but it is a part of the person. So individual means a person like us, individuals. If there is a building and if that building owns by that individual for continuously 3 years, and if that individual lived in that place at least for 2 years period, within that years period, then we will not consider that kind of buildings as investment asset. That means there is a specific exclusion. So for the definition of that investment asset, within that definition we have removed that kind of buildings. Why we have done this kind of thing? Meaning is, if we sold our house where we lived for 2 years period, that we owned that building continuously for 3 years period, that should be exempted from capital gain. That is why we have this kind of exclusion from the investment asset. Otherwise, if we don't have this kind of exclusion, then the building we lived as our principal place also liable for capital gain if we sold that building and if we have a gain. So if we have a gain after selling our principal place of residence, we can claim this exemption if these two criteria fulfilled. So that is why we have excluded that building. Got it? Or if you have question, you can ask. Then as a summary, I can explain it like this. The capital asset can be divided into two parts. Capital asset that is used for business purposes, we call it business asset. After realization of that business asset, if we have a gain, we call it a business receipt. That is why when we are calculating tax liability of a person, in your mid-exam also, I think you have done it, calculated it correctly. If we have an asset that we use for the business purposes, if we had an asset that we use for the business purposes, and if we realized it, the gain was calculated under business receipt. So we have to apply income tax rate applicable in normal income tax rate for that business income gain. If that capital asset is used for the investment purpose, so we have to exclude principal place of residence, we call it investment asset. After realization of that investment asset, if there is a gain, we call it capital gain. In that, you cannot see the capital gain term because we do not use capital gain, the term capital gain. In that, we use realization, gain on realization of investment asset. But for our, in practice, we use this term, two terms, capital gain. So if it is a capital gain for an individual, for the year of assessment 25-26, applicable tax rate is 10%. After that, it is increased to 15%. For a company, it is 30%. So this is the difference between capital assets used for the business and capital assets used for the investment. For the business purposes, we call it business receipt, and income tax rate is applicable, normal income tax rate is applicable. If it is an investment asset, we call it capital gain, and applicable tax rate is for the individual 10% for 25-26 year of assessment. For others, for companies, that is 30%. Then how do we do the calculation? How do we calculate gain or a loss of that asset? It can be a depreciable asset, it can be a capital asset, it can be a business asset, or it can be a investment asset. But calculation method is same. Consideration received less cost of the asset. That is the gain or a loss. Then we should know what is the cost. How do we consider the cost? How do we determine the cost? What is the consideration? How do we determine the consideration? So that specific parts should be identified. In addition to that, we should know what is realization. What is the meaning of realization? So all these clarifications are provided in that. So calculation method is provided under section 36. After that, section 37 says how to determine the cost of an asset, because for the calculation of gain or loss, we should deduct cost of the asset from the consideration. Therefore, we should know what is the cost. How do we determine the cost? So this is the method of determining the cost. Cost means acquisition cost. Acquisition cost means purchase price and cost of construction, manufacturing or production. Sometimes we can purchase an asset. Sometimes we can construct, we can manufacture, or we can produce an asset. So that is the acquisition cost. To that acquisition cost, we have to add improvement cost or a maintenance cost. So prior to 2021 or April 1st, we can consider improvement cost plus maintenance cost. But after April 1st, 2021, we considered only improvement cost, not the maintenance cost. So to the acquisition cost, we have to add improvement cost. Then incidental expenditure can be added to that amount. So what is the incidental expenditure? Cost related to acquiring or realizing the asset. To acquire and to sell that asset. What are the expenditure we incur? We may incur advertising, we may pay taxes, not the income tax but like stamp duty, then transfer duties, legal fees, accounting fees, valuation fees, brokerage fees, ownership defense or preservation. So this kind of expenses can be made as an incidental expenses. To be considered, to be determined the cost of that asset, we have to add that incidental expenditure also to the cost. That means cost plus improvement cost plus incidental expenditure plus certain income amounts. Certain income amount means sometimes we have not purchased, not constructed, not manufactured, not produced, but sometimes we receive that asset as a grant from the employee, as a gift from the employee, like that. So if we have received it in another way, that cost also should be added to determine the cost of that asset. Then under section 16, it explains further. It says, if we are considering this cost, if some amounts are already included in the employment income or business income, we have to remove that part. If we use that asset for different purposes, we have to apportion that between the different income sources. If we use that asset for different businesses that are taxable in different tax rates, then we have to apportion it to each business types, business income. For an example, Company Beta is a land development company. During the year of assessment 25-26, it gives Miss Yamuna, one of its senior managers, a land as a performance bonus. The market value of the land at the time is LKR 3 million. That means he is not purchased that land. Miss Yamuna received that land from that big company as a gift. So, the market value of the land is 3 million. She has not purchased, not constructed, nothing, but it is a part of the employment income. So, if it is part of the employment income, then we cannot consider it under cost of this part, because we have already considered. This amount must be included in calculating Miss Yamuna's income from employment with Company Beta for the year of assessment 2025-26. After that, she sold this land for 3.5 million. As a result, she has consideration from the sale of that asset for 3.5 million. That means she received that land as a bonus from the company. The value of that performance bonus is 3 million. That 3 million should be added to the employment income. But when she is selling that asset, then she has to calculate the gain on that sale. Since it is a land, it is an investment asset because she does not have that business income. So this land can be considered as an investment asset. Then she sold that land for 3.5 million. To be calculated the gain, we have to consider the cost. Cost is 3 million. Then the capital gain is 3.5 million minus 3 million, that is 500,000. That by 500,000 is a capital gain. That is the capital gain. So, she received that land as a bonus. It is not the purchased one, but we consider that value as the cost of that land, even though she has not made any payment to purchase that one, but she received that as a bonus, that land, so she can deduct that market value from the consideration, that is 3.5 million, to be calculated the capital gain, that is 500,000. Now you know how to consider, how to determine the cost. Then how to determine the consideration. It has mentioned under section 38. So that consideration includes amounts received or receivable by the person for the asset or fair market value of non-cash payments at the time of realization. That means at the time of realization, if we have received or if we receive a bill any amount, the fair market value should be the consideration. Income from owning the asset, entitlements to future amounts from asset realization. So all these amounts should be included. Then the grant of an option, but we have to exclude exempt amounts, final withholding payments, and income directly assessed under Division 2, Chapter 2, that means except trading stock. So these are the amounts we have to consider as a consideration. That means the value we received for the selling of that asset. So we have introduced a special rule October 1st, 2021. In that special clarification, special consideration, we have to consider the higher value of the amount received or receivable and the assessed value at the time of realization. That means when we are realizing that asset, what is the value assessed by the certified valuer as the consideration, because there may be some undervalued amounts to be calculated lower gains. They can undervalue their consideration. Therefore, certified valuer's value and the amounts received should be compared, and the higher amount should be considered as the consideration. A tax official may apply general rules if the assessed value does not reflect the market value. So, the tax official has given authority to identify whether the valuer's value is actual or not, because if that real value is not reflected in that value certified by the valuer, then tax official has the authority to increase that value. Then we can move to the realization, because for the calculation of gain or loss, we should know what is the cost. How do we determine the cost? How to determine the real consideration, and what is the realization? In the normal situation, realization means selling our assets to others. That means transfer of ownership from one to another. So we considered only the sale, but for the tax purpose, the definition for realization is more wider. It says ownership transfer, asset is sold, exchanged, transferred, distributed, cancelled, redeemed, destroyed, lost, expired, expropriated or surrendered. All situations are considered as a realization. Not only that, cessation of existence immediately before the person ceases to exist. That means death of an individual. So after death of some persons, the assets ownership will transfer to another person. If there is a last will, when a parent died, the parent's asset can be transferred to the child if there is a last will. That means that is also an ownership transfer, but it is transferred because of that cessation of the existence, death of some other person. So that is also a realization. So we have to consider that kind of situations also as a realization. Not only the sold of an asset, but cessation of existence also a type of the realization. The next one, non-depreciable, non-trading stock asset. When total consideration from owning the asset exceeds its cost. Then the bad debt. Debt claim is written off as debt after reasonable effort to recover. Change in asset use. Asset type changes from investment to personal use. Change of residence. So these are the several situations that the ownership can be transferred to another person. So there are several situations. Each situation should be considered. If we have this kind of situations, we have to calculate the gain or loss on the realization, because since we do not consider the realization, if we are not considering we are not considering only the sales as a realization, there are a lot of situations. So each and every situation we have to identify properly, and relevant provision should be applied to each situation. Not only the assets but to the liabilities also we have specific provisions. So there is a cost and consideration to be calculated, the gain or a loss. We have section 37 and 38 for liabilities as well. So asset references and liability references, that means we considered cost, realization and everything for the assets. That references should be applicable for the liabilities as well. Cost equals expenditure to realize the liability. Consideration equals the amount received from incurring the liability. So that is also the similar calculation should be done for the calculation of gain or loss of the liability. So if there is a loss from the loss from the realization, that loss should be deducted in accordance with section 19(5). Subject to section 194, a gain from the realization of an asset shall not be reduced by any loss. That means if there is a gain, that loss cannot be deducted from that gain. So that is provided under section 19(5). Then the deduction of qualifying payments can be done from the capital gains. So there is a transitional provision. In that transitional provision, it says how to determine the cost of an investment asset. That means, so the way of determining the cost of an asset is given, and the value, which value should be considered as a cost, is provided under Schedule 6 of the Act. Under transitional provisions of the Act. It says the cost of an investment asset should be considered the value as the value as at September 30th, 2017. The value equal to the market value of that date should be considered as the cost, because normally cost means the historical value. Historical value means if we have purchased a land in 2016 or in 2004, in 1990, so the value we paid for that land at that time is the historical cost. So if we are going to calculate a gain or loss on that realization by using that cost, the gain will be a very huge amount, because during that very ancient period, the value of the lands are very low, but now the values of the lands are very high. If we are deducting high consideration from the low cost, the gain will be very high. Therefore, when we are calculating a capital gain only, we considered the market value as at 30th September 2017 as the cost, not the historical value, but the value as at September 30th 2017. So that value should be calculated through the valuer of the certified valuer. So when we are considering, that value should be higher value, and the cost should be the value as at 30th September 2017. So we have several tax exemptions for the capital gain taxes, as I have already explained. There are some exemptions for capital gain taxes. So if selling of shares also an investment asset, as I already explained, it is included in the definition of the capital asset, not only the land and building. Shares also shares also an investment asset. If that investment asset is sold, there will be a gain or a loss. But if that shares are listed shares in the Colombo Stock Exchange, that realization is tax exempt. Gain on that realization is tax exempt. And the next exemption is the government owned assets. If that asset is owned by the government, then the gain on realization of business or investment assets are tax exempt. Now we can move to the calculation. So this is an example. So try to do this calculation. This is an example of Mr. A. He purchased a land on 21st October 2015 for 1 million. Market value of the land as at 30th September 2019, that is 3.5 million. He improved the land by increasing 500,000 on October 6, 2018. He sold that land on 1st of May 2025 for 5 million. He incurred advertising expenses 10,000 and lawyer fees 20,000. So can you do the calculation? Okay. Can you do the calculation? Now you know how to determine the market value, consideration, the cost. Then you can do the calculation. Then you can calculate the gain or the loss. Can you do the calculation? Because I have given you the formula. Consideration minus cost, that is the gain. So consideration should be the higher value of the valuer's value or the selling price, market value. The cost is the value as at 30th September 2017, and to that cost you can add incidental expenses, improvements, like that. So all expenses incurred for the selling and purchasing of that land can be included. After that you can do the calculation. So I can give you 5 minutes. Do that calculation. Try to calculate a capital gain on realization of an investment asset. Since this is an investment asset, we can calculate gain on realization of income investment asset, that is the capital gain. Okay, do the calculation. I will give you 5 minutes period. Hello. I can't see any answer. What is the answer? What is the answer? What about others? What about others? Okay, this is the answer. Consideration received, that is 5 million. Why? Consideration received, you have given, he sold that land on 1st of May 2025 for 5 million. That is the consideration received, amount we received, because I have not given you the surveyor value. We can consider this is as the market value, because this is the value he sold this land. Then the cost. How do we determine the cost? Market value as at 30th September 2019 value, because even though we have given two value means he purchased this land on 21st 10 2015 for 1 million. Actually we do not consider that amount as a cost, because we have to consider the value as at 30th September 2017. If we consider this one as a cost, what is the gain? Gain will be very high. That is why we have given the specific date to be considered the cost. So that is 3.5 million. Then he improved the land by investing 500,000. So improved this land by incurring 500,000 after 2018. Then we have to add that 500 to the cost. Then incurred advertising expenses of 10,000 and lawyer fee 20,000. So all amounts can be considered as, can be determined as the cost, that is 4.2 million. So by deducting 4.2 million from 5 million, the gain is 790. By applying 10% to that 790, that is 900. So I think now you can understand how we have to calculate capital gain tax. Suppose this is not a capital, not an investment asset. Since this is an investment asset, we applied the value of September 30th as the cost. If this is not an investment asset, investment land used for investment purposes, then we have to consider that land as used for the business purposes. If so, we cannot consider 3.5 million as the cost, but the 1 million. That is the difference between business land and the investment land. If so, we have to apply 1 million here, then the gain will be high. We cannot tell that gain, a gain from the realization of investment asset, but the gain from the realization of business asset. Then we cannot apply 10% on that land, but the normal business rate. That means normal rate should be applied to that part. If that person is a company, then 30% should be applied. Okay. Now I am moved to the same question in different way. Okay. Can you do this calculation? I have done very small change. I have made a alteration to one part. Identify the difference between previous example and this example and try to calculate the capital gain. And tell me the reason for the difference. Oh, I'm really sorry. I'm really sorry. So, this is what important thing I have explained is sorry I muted my mic. So I will explain it again. The important thing is here, prior to the valuation on 2017, the improvement was done. Therefore, that improvement also included in the market value as at 30th September 2017. That is why we removed this 500,000. So, most important thing you should keep in your mind is, since this is an investment asset, we can use the value as at 30th September 2017 as a cost. If this is a capital asset used for the business, then we cannot use this 3.5 million as a cost, but the historical value. That is the difference between business income, business asset and the investment asset. Suppose if I have given you a land, details of the land sale, and if I told you in your examination, for your mid-examination, I gave you some land sales details, at that time you applied only the historical value. That is the way we have to do that calculation. I think you can remember when you are doing your mid-examination, I have included this kind of calculations, but it is not for the capital gain but for the business gain. So without any issue, you applied the historical cost for the calculation of the gain. But now I am explaining you about the capital gain. So for the calculation of capital gain, you have to consider the value as at 30th September 2017. මේක මතක ඇති ඔයගොල්ලන්ට exam එකේදී ඔයගොල්ලෝ ගණන් හැදුවනේ මේවා. land එකක් තිබුණා, මේ land එක විකුණුවා, business එකට පාවිච්චි කරපු land එකක්. In your mid examination, I have included this kind of question. There was a land, that land was used for the business, so we can consider that land as a business asset. So you calculated without knowing anything, you calculated the gain by deducting historical cost from the consideration to be calculated the gain. So now you can understand the difference between normal gain and the capital gain, difference between the normal gain and the capital gain. මම හිතන්නේ ඒක හොඳටම පැහැදිලි ඇති. මොකද එක්සෑම්ස් වලදී සාමාන්‍යයෙන් අපි ඒ වගේ ගණන් ඔයගොල්ලන්ට දෙනවා. Okay, there is a question. Mr. Silva purchased the land in 2021 for 4 million and he sold that land in June 2025 for 6.5 million. He incurred legal and agent fees of 200,000 in connection with the sale. So, can you do the calculation? So what is the answer? What is the answer for the first one? What is the answer for the first one? What is the answer? What is the answer? How do we do this calculation? I have not included the slide here for the answer. We can do that calculation. So what is the consideration? Consideration is he sold that land for 6.5 million. So consideration is 6.5 million. Then the cost. So what is the cost? Cost. Normally we considered the cost as the value as at 30th September 2017. So that value should be considered to the assets purchased prior to that date. Here Mr. Silva purchased this asset in 2021. Therefore, it is not necessary to consider the value as at 30th September 2017 because asset was purchased after 2017. Therefore, the value should be considered, the value purchase value should be considered as the cost, and we have to add 200,000 as incidental expenses. That means 6.5 million minus 4 million plus 200, that means 4.2 million. The answer is 2.3 million. 2.3 million. Then the capital gain is 230,000 by multiplying 10. Okay. Then you can go to the next question. Mr. Pereira, this is a residential land, not a principal place of residence. Why it is mentioned? If it is a principal place of residence with the ownership with continuously for 3 years, and if he lived for 2 years, not necessary to calculate the capital gain because it is exempt from capital gain. Here it is not the principal place, therefore it is not necessary to consider that 3 years period and the period he lived in that house. If it is a principal place, then we have to consider whether he owned this land for 3 years period, and if he lived there for 2 years period. Then date of purchase January 2021, purchase price 3 million. So purchase price 3 million can be considered as a cost. Then improvement cost after 21st, that is 500,000. Incidental cost at purchase 100,000. We should add this 100,000, 500,000, 600 plus 3 million, 600,000. Then the selling price is 6.2 million. Selling expenses 1.5 million, that is also should be added to the cost of the asset. That means 3 million plus 500,000 plus 100,000 plus 150,000 plus, that is the purchased value, that is the cost. Then selling price is 6.2 million. You can deduct it from that consideration. Here date of purchase 2016, purchase price 2 million, but market value should be considered because this is prior to 2017, therefore market value as at 30th September 2017 should be considered. Incidental cost 150, improvement cost 400, sale price 6 and selling expenses 100,000. All together, that is the cost, can be deducted from the selling price 6 million to be calculated the capital gain. Okay. So we have already calculated the capital gain on the realization of an investment asset. In addition to that kind of realizations, there are several types of realizations. From section 41 to other sections, there are some computations, some provisions are available for the realization. So every realization we have to identify the situations in that realization. So based on that situation, we have to apply the relevant provision. Yes, we can start from here. It says transfer of assets to an associate or for no consideration. That means we transferred our assets to an associate or for no consideration. So section 46 prior to that, no, we have to apply this one. Transfer of assets to spouse or former spouse or on death. That means assets can be transferred to spouse or to former spouse. So it is not the it is not the sale, but we consider that kind of transfers also as a realization. That means in the divorced, when a couple separation of the married couple, divorced of the married couple, at that time they can transfer their assets to spouse or to the former spouse. Then the realization is occurred. That realization we have to consider for the tax purposes, but at that time we consider that realization is happened with net cost. Net cost means no gain, no loss situation. The transfer is treated as having realized the asset at its net cost. Net cost means we consider the same value we purchased, and the value we purchased is equal to the realization value. Therefore, no gain or no loss. The recipient is treated as having acquired the asset at the same net cost. But after that situation, after that transaction, if that spouse sold that asset to another third party, then we have to calculate actual gain or a loss by considering this net cost as the cost. For an example, there is two persons, A and B. A transferred his asset to B for 100,000. So that is the net cost. After that, B can sell that asset to C for 200,000. Then consideration is 200, cost is 100, the difference 100 is the gain. Likewise, we have to do that calculation, but at the time of realizing, transferring that asset to the spouse, we do not tax it. We do not tax it. We are deferring that tax liability to future activity. Same as at the time of death of a person, when an individual transfers an asset on death, the deceased is treated as having realized the asset at its net cost. That means the deceased person realized the asset at the net cost. That means මැරෙන්න මොහොතකට පෙර realized prior to his death. The recipient is treated as having acquired the asset at the time of same net cost. This is also similar to the previous transaction, previous situation. Then after several periods, after acquiring that asset from that deceased person, he or she can sell that asset to another third party. Then the gain or a loss should be calculated based on that cost. Net cost is the cost of that asset, and the realization value should be considered. After determining the realization value, gain or a loss should be calculated. Do you have any issue? Any question? Next one is yes. Question?
මට හිතෙනවා අපිට ළමයි නැති වෙයිද දන්නේ නැහැ කියලා. අපිට ළමයි නැති වෙයිද දන්නේ නැහැ කියලා මට හිතෙනවා.
Inosha, can you please mute your mic? Then transfer of asset to an associate for no consideration under section 46. So we are here we are considering two situations: transfer of asset to an associate or for no consideration. General rule is transfer to associate or gift. That means we can transfer our assets to associates. Who are the associates? We have a specific definition for the associate. So, and according to that associate can be close associate, child, spouse, parent, etc. So those are the associates. In this situation also, we consider if that transfer is to an associate or if that transfer is for a no consideration, that means if we gifted an asset to a charitable institution, at that time we consider that transaction was made at net cost. Here also, after selling, after realizing that asset to a third party, at that time we have to do the calculation for gain or a loss, and tax should be paid accordingly. So section 46 is very important for the institutions, because to be considered their transactions at net cost, they are making several arrangements. Therefore, in the practical situation, mainly taxpayers are trying to apply this section 46 incorrectly to obtain that benefit. So this is for the associations, associate persons, and to the charitable institutions, that is under subsection 2. In addition to that, specific provision is available for the companies. So if for that specific situations, if there are some associates in the organizations, that means that associations are holding companies, subsidiaries, or associate companies. If that is in respect of an individual, associate means child, spouse, parents, etc. But in respect of a company, associates means directors, shareholders, subsidiary companies, holding companies, associate companies, like that. So at that time, several conditions should be fulfilled to be considered this transaction for the net cost. So one is the assets in business. Asset is business related asset should be there. That means the asset should be a trading stock, depreciable asset, investment asset, or a capital asset. Then the person or associate is an entity. At least one person, that means the person who transferer and transferee, two persons should be there. Definitely one person should be an entity. So asset continues as a business asset of associate. That means if it is a business asset, if it is a trading stock in the hands of the transferor, in the hands of the transferee also, it should be a trading stock. That relation should be there. And both companies should be resident and taxable at the same rates. So those are the main conditions should be fulfilled. In addition to that, after transferring of that asset, underlying ownership of that asset should be more than 50%, and that ownership should be, continuity of the underlying ownership should be there. So those are the main conditions should be fulfilled to be considered this transaction at the net cost, because it is a benefit to that organizations. Therefore they are trying to take that opportunity by misinterpreting this section. This is one of the most misinterpreted section. So therefore clarifications also issued in respect of this issue, this section. This is applicable for associates, mainly associates. Therefore some arrangements can be happen to reduce the payment of taxes.
Hello.
Yes.
Madam, in the previous slide, this section 46.
Yes.
Yeah. Now, if if a group company where the same tax rates are there, like a 30%, all the holding company and the two subsidiaries, if they sell a capital or investment asset, then in this scenario, under this subsection 4, we can treat this net cost is 0. Am I correct?
Actually, there are some more criteria, not only that one. Other criteria also there. So to be considered it under net cost, that all criteria should be fulfilled. So asset relationship should be there. If in one person's hand, if that asset is a trading stock, in the other person's hands it should be a trading stock. Otherwise applicable tax rates may be vary, because actually we have applied this when we are having different tax rates for business income and investment income. Earlier we had that kind of situations, therefore we have already issued some private rulings also mentioning that. Therefore if it is a trading stock in one person's hand, after transferring that asset to another person, in the hands of that person also it should be a trading stock. In addition to that, underlying ownership should be there. So that is also very important. So all these criteria should be fulfilled to consider that sale under section 14 under net cost.
Okay, so if one company doesn't fulfill this, just say 30 to 20% rate, and all other criteria are fulfilled, then they cannot get this benefit. They have to tax at the normal rate. Correct?
Yes, at the normal rate. That is, as I explained, this is one of the most misinterpreted section to get that benefit within that associate company. So that is why we have already issued rulings also. So
Okay.
all criteria should be fulfilled.
Because this business asset, it doesn't interpret in under section 195. It's only mentioned this section 46, isn't it?
Yes.
So then,
It says this is applicable. This asset can be trading stock, depreciable, and is asset, investment asset, like that. And the same asset should be in another person's hands also.
so then both have to be used for the production of income for the business purpose. Correct?
Mainly.
Now just say one company is selling a depreciable asset,
Yeah.
and the other company doesn't use for that. It might be used for investment asset. Then,
Yes. Then there will be an issue.
then issue. That's mean, yeah,
Yes.
okay.
Yes, there will be an issue. If it
Then
is
even
a
though the
trading stock,
below criteria are fulfilled, even like just say we might use a building for depreciable asset, but some other, my parent company use that building as a investment asset. Then we
yes.
can't claim as a, there's no
We
any gain,
can't.
that the gain arising, we can't.
Yes, actually we can't, because applicable tax rate, earlier applicable tax rates was different for the business purpose. For the business sectors, sometimes applicable tax rate is lower tax rates also applied, but for investment part we applied higher tax rates. So if it is in the hands of one person's, if it is an investment asset, applicable tax rate was lower, but in the hands of the other person applicable tax rate is higher. If we transferred our assets to that to avoid paying taxes, then there will be an issue, because this section 14 was introduced not to avoid taxes but to defer taxes. Only
Correct.
only deferment is available. That means at the time of realizing that asset within the associate persons, it is not necessary to pay the taxes, but if they are selling it to another third party, that same tax should be paid. So that means it is not for the avoidance scheme, but it is for the deferment facility. So that is why
Okay.
we included that kind of criteria. Okay.
Madam, for this one, you don't have, the inland revenue hasn't issued any public ruling, no? Only
No,
private rulings.
actually, no. Only private
No.
rulings we have issued, not the public ruling. Because after considering that private rulings, we have made several amendments to Section 46.
Yes,
So
correct. Okay.
yes. So now we have corrected some issues in Section 46. Still we have, because we are identifying that kind of issues when we are seeing some applications made by the companies, because they want to make some arrangements to avoid
Yes.
paying taxes. At that time we can see some loopholes in the act. So then
Okay,
we
madam.
are doing some changes to the act.
Okay, clear. Thank you, madam. Thank you.
Okay. Okay, so this is just an example to identify whether that is an investment asset or a business asset. Here, Miss Damayanti passes away. Miss Damayanti operates a small publishing business through a private company. Upon her death, she leaves the unlisted shares in this company and her holiday apartment to her daughter. She died, so she her assets transferred to Erandi. So at the time of her death, that the first scenario, first situation, that is, that amount can be transferred to the associate on net cost. But if that Erandi sold that assets to different person, at that time we have to calculate the capital gain if it is an investment asset. In the second part, she bequeathed the collection of valuable artwork to her long-term personal assistant. So that is also, it is as a gift. So not the associate, but to another person as a gift. So at the time of her death, the cost of these assets in Mrs. Damayanti's hands were shares in the company 4 million, holiday apartment 3 million, and artwork collection 1 million. Their market values at the time of death, you have given the market value. Without considering that market value, she can transfer those, she can realize these things at net cost. So after that, if that Miss Erandi and Mr. Farin sold their assets to another person, at that time we have to collect taxes. Then we have to calculate the tax liability and gain and the tax liability, and should collect taxes from that second transaction, not the first transaction. So under section 39B, Mrs. Damayanti is treated as, so you can read this part. So everything I have already explained, I included here. So shares in the company are investment asset in Erandi's hand, because she is not doing any businesses. So this is just an investment asset. Therefore, capital gain should be calculated. So the holiday apartment also an investment asset, and Erandi did not occupy it as her principal place. If she occupied in that building as her principal place, and if she owned it for 3 years, for continuous 3 years, then it is not taxable, it is exempt from tax. Then the artwork also, and it is also an investment asset, so it is received as a gift. So after, when he is selling it to the third party, it should be taxed. Then the involuntary realization of asset. So involuntary realization of asset with replacement. So it is under section 47. So involuntary realization means normally realizations are happening voluntarily. That means if I am not, if not in the death, all realizations are happening voluntarily. Involuntary realizations can happen mainly as a compensation. That means if we are having a land, and if this is an example, if the government wants to expand that the roads within that area by using that land, then the government can pay some compensation to that individual or an organization and obtain that land from that person after paying some compensation. So that is the involuntary realization without having any requirement for the realization of the owner. He had to do it. So we call it involuntary realization. So if a person involuntarily realizes an asset, then under section 49 he can apply this provision, but for that purpose consent is required. So acquires a replacement asset of the same type within 6 months before or 1 year after, and elects in writing. So all these criteria should be fulfilled. Then that person can consider it as a net realization amount at the first transaction can be considered as a net cost of the original asset. So if there is some excess amount, for that excess amount tax should be paid, because after we are receiving some compensation, using that amount we have to purchase similar thing from another place. If it is a land, within 6 month period prior, before 6 months of the replacement, or after 1 year period, we have to replace the same asset. Then we can consider it as a without paying taxes, we can consider it as a compensation. So I will give you some examples in the next week, so I couldn't prepare some examples. So with that example I will explain this section 47 again, because without giving an example it is difficult to identify what I am talking. Therefore I will do it in next week. After including some example here, I will share these slides with you. So the next one is realization by separation, that is under section 14 by separation. So it is like a leasing. It is like a leasing transactions. If that leasing is for more than 50 years period, we consider it as a permanent sale. If it is less than that period, we can consider it as it as just a leasing, not the permanent sale, temporary transferring. Then we have another section, that is section 49, transfer by way of security finance lease or installment sale. So this is also very important, because if we can purchase some assets for finance lease, we can sell some assets under finance lease. If it is a finance lease, at the time of purchasing that asset under finance lease, we consider that the ownership transferred to the lessee. Lessor is treated as transferring ownership of the asset to the lessee. Lessee means the owner of the, lessee means the purchaser, lessor means the seller. So if it is under finance lease, we consider it as a sale. At the time of entering into the agreement, we consider it as a sale, even though it is a finance lease. Okay, So next week I will give you a few examples for involuntary realization. It is important. So after that I will share you these slides. Now it is time to close. Yes, it is almost 10. So we can finish the session now. If you have questions, you can ask. Otherwise, we can stop the session. Okay, then we can stop the session. Then good night to all of you. Thank you very much. Good night.
Good night, ma'am.